So we're going to be looking at explaining and preparing the closing entries. If you remember from last semester, closing entries, this is where we want to make sure all of our temporary accounts are closed and our permanent or real accounts stay open. Real accounts or permanent accounts are the accounts that carry their balances from one period to the next. They are mostly, or they are all, what types of accounts? Where? Balance sheet, income statement. Which are they? What types of accounts are permanent accounts? Balance sheet accounts, right? We carry them from one period to the next. If you owe somebody money on December 31st, do you still owe them money on January 1st? Yeah, unless you paid off the balance, you sure do. Okay? Temporary accounts, nominal accounts, are accounts that we zero out at the end of the fiscal period and roll their balances into our statement of into our retained earnings, basically, for our business. So our revenues minus our expenses, we get a net profit. We roll the net profit into our retained earnings. And we close all of the, thank you very much. We close all of the temporary accounts at the end of the year. Good? Not good. Good? Go? Yeah? Okay. So closing entries, they basically set the stage, if you will, for the next accounting period. We zero out those balances, summarize the income for the period, and then the balances of those temporary accounts are at zero, so we can start the new fiscal period with a zero balance. The permanent accounts are the ones that we carry the balances into the new period. The income summary account itself is a temporary, very temporary account. The only thing it's used for is the closing process. Does the income summary account have a normal side balance? No, it doesn't. Because in a period where we have a loss, it will have a credit balance, and in a period where we have a profit, it will have a debit balance. So when we close it out, it will cross it out and transfer it into the appropriate side of the retained earnings account. The post-closing trial balance, it will have only what types of accounts in it? Permanent accounts. And what does a post-closing trial balance do? Similar to the trial balance? Right. It's just a test to make sure our debits and credits equal. It will only contain balance sheet accounts because all the income statement and dividends accounts have been closed. And this is just an overview of the closing process, where we're going to close our revenue accounts out to the income summary, our expense accounts out to the income summary, and then the difference is rolled into the retained earnings, and the same with the dividends. Good? You don't have to fill anything out there. Right? Yeah. Okay. We're not going to do this stop and apply. We're going to move on into Objective 6. I guess I don't have a separate sheet for Objective 6. Objective 6, we're just looking at the cash flows from accrual information. So when we look at cash flow, we're really looking for how the cash comes into and goes out of a business. Almost every income statement account can be paired with a balance sheet account. So for instance, our supplies expense account is related to supplies. Okay? Our wages expense is related to wages payable. Revenue to unearned revenue. So we're looking at the cash inflows inflows and outflows of for a business to understand how the business is maintaining its liquidity goal. That's the purpose there. Cash flows help to look at that liquidity goal. So when we're looking at trying to determine cash flow from an accrual-based system, accrual-based business, when we're looking at prepaids, so this is important for you guys. If you have a problem that you're going to do, say for homework or something, and it's this is a good little toolbox for you. Like if it's a prepaid expense, what you're going to look at is using the formula that's there, ending balance plus the expense for the period minus the beginning balance is going to give you the cash balance for the year, for the cash payments that have been made for the expenses for the year. When you have unearned, again, you're going to look at the ending balance plus the revenue that was recorded for the period minus the beginning balance. It'll give you what you received in cash from revenues for the year. And then the other two for accrual, accrued payables and accrued receivables. Those are the formulas you're going to use. So you just need to know to apply those formulas when you get a question relating to cash flow. Like if you had if there was a question relating to what were the cash flows from prepaid rent for the year, you'd use that formula. Okay. All right. Let's go and do some formulas, and that's the end of notes for chapter 3. So we're all through the notes for chapter 3. Okay.